well, let's dive in. I did want to bring up and talk about our version of the investment committee. I know we've got a number of brand new AEs that are in the network, and thanks to all who have joined. If this is your first time, again, welcome. If it's maybe your second or third, or you're just getting your feet under you, as you will quickly determine if you haven't already, we have a mountain of content in our training program. It might feel like drinking out of the proverbial fire hose if you haven't ever done anything like this before. I would encourage you to maybe sit with your favorite adult beverage as you begin the journey and just enjoy the ride, but definitely try to consume the material at your own pace and go back as many times as you may have to kind of grab the essence of whatever a module might be bringing forward. But as for those of you that have done your onboarding call already, you've heard us talk about a sequence of events. Diving into the training is number one. Number two is finalizing your first cut at an investment thesis. And then the next milestone after that is turning your attention to preparing for our investment committee. And again, I'd like to reiterate our investment committee, despite its name, we don't have cash on the table. I like to, as many of you have heard, I like to call it the Shark Tank without the money. And it is a process, and it's a process that is in place in the flow of things for a reason. And we're going to talk about that today. We're going to talk about both the spirit and the reason behind it, and then we'll get into the mechanics of it itself. But first, the kind of the backstory that I like to share with folks. At one point or another, you are going to be asking somebody for money to do these deals. And we are, as you likely have seen, we are big advocates of taking advantage of the leverage opportunity that you've got with the SBA lending programs, working with preferred lender banks. We talked about that last week with Alan on board. But the thing that happens when you're asking somebody either to be an investor or a lender on your deal, there are two fundamental questions, and I can say this with absolute certainty as a former banker. Dana can attest to this, and I don't think our friend Dick Hindy's on this call today, but if he were, he would attest likewise, also being a former banker. When a banker's approached by someone that might be a prospective borrower, there's two fundamental questions that are at the core of everything on that banker's mind. Question number one is why you? And question number two is why this deal? In this case, why this business? So why you and why this business? And implied in all that is maybe a third question, why now? That you'll get into that in some degree with the discussion. But really, those two overarching questions are what drive the notion of coming to and participating in our investment committee. We want to give you a dry run, dress rehearsal, if you will, putting material together that can address those two fundamental questions. And our prescribed investment committee slide deck that is in the training material will, over the course of 16 or 18 slides, maybe more, will peel that onion, if you will, and we'll get into the details with a thorough and complete answer for those two very fundamental questions. Excuse me. If you can ace those two questions in the eyes of your SBA lender, you are well on the way to a successful loan opportunity with them. And Alan Peterson, I guess I would call him our lead lender, if you will, if there's such a thing. we don't really quite think of it that way, but Ellen has probably serviced more of our transactions than any others. He will tell you he has on occasion turned away a borrower just because, in his gut as a lender, he doesn't think there's an upside of probability of success just based on maybe the person's background or something that got said along the way that made him think that it was a questionable choice to be marrying up those two questions. Why you? Why the deal? Do they work together? And my point is that does happen. It does happen in a lender's mind. It could happen in a private investor's mind if you're asking friends, family, or others for some private money to go with you. They're going to be asking the same kind of thing. They may not know it as specifically as an SBA lender would, but they're going to know it, and they're going to have those same kinds of questions. So that's kind of the gist of that's kind of the genesis of the reason we want to do the investment committee. We want to give you an opportunity to prepare for, think about some data points that could help answer. And I would go so far as to say, even though our deck suggests otherwise, the whole point of the investment committee is not to get you to be a super numbered cruncher, although you're going to feel like that at some point probably in the journey with some of the schedules and modules and templates that we recommend. But it is more about thinking through the deal for successful completion of those questions. Does that make sense to everybody? Anybody got any questions on that before I get into some of the details? Okay. Well, what I'm going to do is I do have our template available. I'm going to pop it up in a share window. Let me get that orchestrated here on my desktop just a moment, if I may. So this is our prescribed template. So page 1 is you could call it an executive summary. It's a deal overview, company name, location, the industry it's in, so on and so on. This kind of helps set the tone of what the deal may be about. And then as we move on to page 2, this will be a recap of the offer. Effectively, this is the summary of your LOI, what you might have quoted or calculated for a purchase price. Some people may, in this process, because this deck is really considered private, it would be between you and us, the investment committee. And if you do take it to your SBA lender, there's a degree of confidentiality there, so you can elaborate as you might. Excuse me. This is a place to talk about if maybe in the original sale listing, the asking price is different from the price you chose to offer. You can elaborate on that a little bit. I can tell you that there are moments when the banker, knowing that there was an ask price that was maybe a little unreasonable, that you did the work to come up with a logical offer price, that scores points with your banker. May not score points with the seller or the broker, but if you have a good, solid logic for that, you could win the day with both the broker and the seller. There are times when we have had AEs do the work, do their calculation, and come in with an offer that was less than the asking price, but it was substantiated for good reason. And it might have been initially declined by the seller, but then the phone will ring weeks and sometimes months later when the deal just sits on the market and is not going anywhere, and the seller and the broker together come to the realization that maybe their original asking price was unreasonable, and if they could get X dollars, they're happy to do it. If the seller's need is strong enough to get out of the business, your offer might prevail because you stood it up on good logic and solid justification. So don't be shy about cutting the asking price. But all I'll say is please have a logic that you can explain to the parties if you're still going to try to present it. And a lot of times what we're talking about is maybe a half point on the multiple, something like that as an adjustment, not a giant adjustment like a full point or point and a half on the multiple, but something that's kind of like close but no cigar, that sort of logic. But if you can point out your cautions and why you're discounting the multiple to get to the number you've got, a lot of times level heads will prevail. And to Alex's point, the broker may take it under advisement, think about it a while, and go back to the seller and say, this guy's got a good point, that we probably ought to revisit what we're asking for this deal. Your due diligence summary is the next slide here. This is where we kind of break down the key elements. These are the segments that are also reflected in the intrinsic value calculator model that we have in the training. Each of these areas is something to look at in due diligence and determine whether or not there are strengths or weaknesses in the position and history of the business that you want to account for. This is a good time to remind you that what you'll see in our training, we refer to the intrinsic value calculator twice. We want you to do an initial pass when you're working up your LOI. We know that the initial pass may not have complete data. You're going to have to make some assumptions. You're going to have to take what you can from the information you've already been given to make that first pass, and that's okay. But certainly before you ever get to a final investment decision, which comes after due diligence, you would want to make a second pass through the intrinsic value calculator. And again, that helps firm up your determination of what the proper multiple should be to offer on the business. So because the investment committee often happens kind of between an initial LOI and a final investment decision, when you're doing the investment committee, you're going to be kind of in between on your due diligence. You might not have all due diligence fully complete yet, and you might not be able to answer all of these areas with 100% accuracy, but that's okay. Just know that this is something you're going to want to shore up before you maybe do take a run at a banker to pitch the deal. The org chart describes the business as best you know it. This is a place you start identifying the structure of who will be retained when you buy and acquire the business. It does indicate possibilities of key man risk. If you've been on this call for a while, you'll know that we've had talks from time to time. The owner may be selling out, but you discover that there are some key positions on the org chart that are filled by family relatives. And, you have to make a determination about their willingness to stay or the risk that may be inferred by them being connected to the seller and potentially wanting to move on when the seller moves on. And you have to determine how big a hole that may leave in your organization. It follows up to the org chart to really itemize key management and personnel that are in play. If the business is very owner centric, meaning the owner is fundamentally doing everything, touching everything, this page is going to be really thin. But hopefully you can find a company where there's a little bit of depth in the organization. You might not have a full-fledged general manager, but if you have some sort of field lead or office manager or chief estimator or something like that, those are important roles to have on the list here to be sure that you're not stuck having to do everything on day one moving into the business. We've got a page here to talk about facilities and location. Every one of these businesses usually comes with some form of obligation on renting a facility, or we had one recently that was housed in somebody's residence, and so that's an issue on transfer and transition. It would put that business needing to be relocated right away to move out of the seller's home. Interesting dynamic when that one came up. But also on the high side of this situation, you could be looking at the real estate for the facility being included in the transaction, whether it's an office building or a work yard or a shop or storage yard, something like that. We've seen all manner of combinations here. This next page gets into reputation of the company. Now, this can start with something like Google reviews, but it's also important to glean from the SIM, whatever statement they've made about the history of the business. A lot of times we'll see commentary that says, well, the business has been in place for 30 years in this market. We have this connection, that connection, whatever. This is a good place to share that and bubble that information back up. The reputation of the business helps answer that question of why this business. No banker wants to entertain the idea of becoming an investor in a business. That's not what they do. Bankers are lenders. They want to give money for temporary need, but they expect full payback. So having a good reputation story helps build some confidence that this business is viable and is going to, at worst case, it will maintain the level of performance that might be indicated in the financials. It's not a function of needing to still be in a startup phase, worrying about how it's going to grow. You can address all that here in the reputation section. Demographics is important to describe the area where the business is located. This is where we talk about your metropolitan areas, what their growth projections are just as a community, city, town, whatever. I can think of a case last year. We had someone find a business that was in an area that was not very densely populated. I think the local township was only about 50,000. The business already had a pretty high level of market share in that area. So the upside growth potential was not strong. It was to be static at best. And that ultimately is not the kind of business that particular AE was looking for. And when we really drilled into the numbers on the demographics, we realized there was virtually no upside for that business. In fact, there was risk that it was going to shrink as opposed to grow. So it became a no deal. Industry dynamics here. This is where you can talk about what may be happening in and around the segment you're in. We have more and more AEs that are entertaining ideas outside of the core home service business. As I've told everyone I've talked to, just because Acquira's training material is sort of centered on home service, and we have a lot of references to home service in our material, that does not mean we are not fans of other kinds of business. We are. It is, again, a function of proper alignment of your own background to be ready to go into that particular industry segment, and or the strength of the deal itself and what it's looking like. So this is a page to address some of the industry dynamics that might be pertinent to your deal. With that, we have a classic early stage SWOT analysis. We have a grid here to look at risks that are perceived in the business. And next to it here, the green light would be your answer to what you think you might be able to implement or action on to mitigate the risk. If the risk is, for example, no general manager, okay, well, you could make a statement that the EBITDA has enough elasticity in it that you could see allocating budget to going out and recruiting a general manager or promoting from within. You might name someone on the org chart where you now have information that they might be a general manager in waiting, and for whatever reason had just never been given that opportunity. So they might be the designee that you're going to elevate to take on that role. Often in this risk chart, we run into the question of licensing. I've had several licensing discussions with some of our newest AEs recently, and I just, for the benefit of the group here, I want to share that licensing is an issue, no doubt about it. There is a challenge, but in most jurisdictions, it's not insurmountable. There are some jurisdictions. Let me back up a minute. Licensing is ultimately a function of what the local statute says, either state, county, or sometimes even city will have statutes about licensure for trades like electricians or plumbers. And depending on where the business is, that local jurisdiction is going to be the prevailing statute that you've got to follow. In some cases, you can essentially rent a license. You can get someone that has the appropriate licensing to stand up as the qualifying individual for your company. There's a process to file that with the licensing authorities, but it can be done. There are other jurisdictions, however, that do require licensing to hold an interest in ownership of the company, up to sometimes including majority ownership in the company. So what that inevitably does mean, if you are an individual that is nowhere close to having a license and you're going to be the majority owner, you would not be eligible to have a business of that kind in that particular location. So that does sometimes become a disqualifying consideration, and it's understandable. But the good news is, in the vast majority of the markets where we have had deals closed, successfully acquired, I should say, we have been able to work around and with the statutes and satisfy the licensing requirements. In many cases, companies have people on payroll that are on the path to obtain the proper licensing to allow the business to operate, and that can become part of your go forward management strategy is to support those people in finalizing whatever next steps might be remaining for them to complete their licensing requirements. And that could be a mitigating factor. You could say John Doe is now a journeyman. He's got a journeyman license, and we're going to help him step up and get his master license. So there are things like that that can be identified as mitigants. Finally, on page 11 here, we get into some financial performance data. Typically, we frame this to be 3 full periods of prior history. We kind of center on the 3 periods because that's where most SBA lenders, they want to see that 3-year trend. And if we are deep into a new year, so let's say in the September through November part of a year, and we're trying to analyze, they're going to want the last column here to be the trailing 12 months. So if you're doing this in a September timeframe, you would go back 12 months to the prior September, show that trend line. But then in the middle column right before that, you would have the full year reporting of that prior year, if that makes sense. So in a fashion, you could say that September of the prior year gets counted twice, but it's still a way to indicate trend lines for the business. Anybody confused by what I just said there? Let me pause and take a question if anybody didn't get that. No.
So you're saying the final column is the trailing 12 months, and then the columns before that are the fiscal years?
Yeah, the columns before that would be the fiscal year. The last one would be the trailing 12 months, but that's only pertinent depending on what time of year you're trying to propose your deal. Like right now, we are early in a new year. We're just going to be wrapping up the first fiscal quarter of 2025. So typically you go ahead and try to get you would have 24, 23, and 22 reflected in this chart. And you would make maybe a footnote that says, and the first quarter of 2025 is on track compared to the prior year, or something like that.
Makes sense. Thank you.
Okay. So yeah, my point is that third year needs to be as much of a full year trend as you can get. And as we get later into the year, we typically try to make that be a trailing 12-month number so that you can still somewhat do an apples and apples comparison of prior years and the trend lines for the business. One of the big reasons this is important, that last period that gets reported, sometimes when sellers make the decision to sell their business, they take their foot off the gas. And we see a dip in either the last fiscal year or the trailing 12 months. And that's a fair question to really be pressed onto the seller and say, you know, what happened? Did you lose a client? Did you just take your foot off the gas? You know, what's really going on here? And while everybody can appreciate a little bit of a dip, you're still going to want to be able to see those numbers on a trend line that then you can forecast for the future and show the banker that these numbers will carry the debt service, because that's the basis. But if you have a giant bubble, a giant dip in that immediate prior period, it's going to be hard for the banker to rationalize that you're going to pull up, magically go back to the higher levels on the first day that you take over the business and be able to support the debt. So these trend lines do make a difference, and it's important to get as best data as you can. And if there are any anomalies or declines that are unexpected, you've got to try to research and work with the seller and get a good, solid explanation of why that is. And again, maybe is there a mitigating factor that you can address that will bring it back to where it needs to be? By the way, customer concentration is a big part of that. We've had a deal recently where I think we were, as I'm recalling it, we were partway into the final underwriting of the loan, and it was disclosed that the company's largest customer left and went away. And Dana, if you'll still here with us, you might remember what the percentage was. It was a pretty sizable, I want to say something on the order of like 30% of the business. So it was a pretty major hit to determine that that big customer had gone away. But again, that gets back to some of our work here on, I'm going back up, let's see, customer concentration. It's part of the due diligence analysis here. And it can also show up in risks and mitigants. If the customer concentration is too high for 1, 2, or 3 big players, you have to have a mitigating strategy on what's going to happen if one of those leaves. So that's something to call out and identify proactively to let your lender know that you've got it on radar and you've thought through it and have an answer for it. The next slide gets into seasonality. Some of these companies do experience seasonality. If you're a heating and air company, you're going to have certain peaks for seasons of the year that require higher loads of air conditioning, or vice versa, higher loads in usage of furnaces and heaters. So if historically the company reflects some of that seasonality, you're going to want to do the same. Because the big question with seasonality in these trade companies is that you might have personnel issues. If there's no work, people tend to leave and want to go do something else. So you need to have an understanding of what, if any, seasonality impacts the business. Again, we hit in more detail on customer concentration and identifying percentages occasionally. What I'll say is this: companies that tend to be more general contractors, they tend to have customer concentration factors that are sometimes difficult to work with. A general contractor may have, I'll say 3 to 10 developers that they do a lot of work for, but you have to get the distribution of, on that list of, if it's 10 developers, you have to understand line by line how much contribution does each one provide to the history of the business. And that's the way you determine what your risk may be if 1, 2, or more of those go away for any reason. So really important to identify. That's also true with companies that tend to support government contracts, city, municipality, county level, things of that sort, special projects that may be coming out of those. Companies with contract obligations to those kind of entities have longer lead cycle on approval for projects. So that impacts cash flow. And again, definitely something you want to understand. Sales segmentation is where we get into variations like you see here, whether it's service-based business versus construction, commercial versus residential, insurance paid versus non-insurance. A lot of our roofing companies, they are heavily involved with insurance paid claims. So you want to understand how that is set up to work and impact the cash flow of the business. If it's insurance paid, you inevitably have an overhead burden of processing payments and getting the proper filings done to get your payments. because you're not dealing with the consumer necessarily, you're dealing with the insurance company. So understanding how those contracts are set up is going to be important. But this is also a place to identify opportunity. Many times companies may show up being exclusively operating in the residential service realm, and they haven't done much with residential installation. So you might ask the question, well, what would it take to create an installation arm? Those are typically higher ticket opportunities, something that could be an immediate ad. Conversely, if a company's in service, in installation, maybe they need a service leg and can do something with a kind of a membership program kind of opportunity. We've seen a lot of interesting developments with expanded sales segments that become quick wins for the new owner. Now we finally get to the acquisition entrepreneur fit. This is the why you question. This is where you get to share an overview of who you are, talk a little bit about what you like, dislike, any unfair advantages you may have because of experiences or job history that could be particularly pertinent to the deal, and whether or not you are entertaining relocation to make this deal happen. It's kind of a full disclosure moment to share with the banker all these parameters so that they understand where you're coming from and what you're going to be faced with as you move in. The offer scenarios, that this is more toward your final investment decision projections of what you're learning during due diligence and whether or not you're going to have to modify the terms of the LOI that you might have already issued, and presenting through what those changes may be, if any. This is also a place to talk about combinations of seller note, the ways that you might be thinking of structuring the seller notes. You heard Alan, or if you weren't here, you can hear him on his talk about it. It's not uncommon that when we think about seller notes, we do an A note and a B note. The A note is a simple term note to help satisfy part of your equity down payment in the business. The SBA 7A program does allow up to 5% of the down payment, and half, that is, of the down payment to be satisfied with a seller note. So if you're looking at a $4 million purchase price, that would require a $400,000 down payment. $200,000 of that, half or 5%, can be satisfied with a seller note. You can do that A note to cover that part, and then any other difference that you are going to ask the seller to consider, you put in a second seller note, or a so-called B note, A and B. The B note might be a larger amount and under totally different terms, potentially a portion of which might be forgivable if certain events do or don't happen in the business. It's a pretty popular scenario from the buyer side. Not always well received by the seller, but something that is a really strong strategy for buyers, and sometimes the only way you can justify getting some of these deals done. Lastly, we move into a little more financial forecast. This is where you can add in some of the other pro forma models. The SBA calculator model that has the debt carry calculation in it. It's, the technical term is DSCR, debt service coverage ratio, is a number that the bank looks for to be sure all projections support the payout on the note when it becomes due. Any links to the detailed P&Ls and any other financial modeling you might be doing, we go in here. And then again, the second pass on the intrinsic value calculator is referenced here. And then lastly, well, I got ahead of myself. The SBA model calculator, that's the one that has the DSCR projection in it. Now, these are forward-looking models, not historic models. These are forward-looking models that should be tied with no surprise trend over what the history has told you. If the business has been rocking along, let's say at $3 million topside revenue, your forward model can't immediately jump to $5 million in year one. That's not going to be a logical answer. You're gonna need to show that trend line moving forward. And if you're going to grow the numbers, you need to have an explanation of what will be happening to get you there. And again, we can talk through that during the investment committee and any subsequent discussions we have. But thank you for enduring this. That was a long, kind of a long journey through the deck. I'm going to go back to live view here and open it up for questions. Anybody? Yeah, Kyle.
Hey, what's up, Doug? Great presentation. I was just curious, like, I don't think that there's any specific rule of thumb, but customer concentration, like, do you have a rule of thumb as far as different industries or kind of what you look to stay below, or any guidance?
No, if there was a rule of thumb, the answer would be the classic, it depends. I don't, Dana, you may disagree. I don't think there is a generality on customer concentration. I think every business ends up showing up a little bit differently. It's just the real point here. It's important to understand what that looks like and ask as many questions as you can about that, because high concentration of only a handful of customers is a high risk proposition.
Yeah.
You know, that's the bottom line.
Very, very high risk. And we've got somebody now that has a letter of intent and is in the process of negotiating a transaction and has been notified that the largest customer is taking their business elsewhere, taking it internally, actually. So that'll give you an idea of just how risky that it can get. So,
yeah. That was the one I was alluding to, everybody. Dana might have had to be offline temporarily, but I mentioned that. That was the same one I was referring to, that we're kind of in the early throes and learned that a very large customer is leaving. And allegedly, the seller has a few more deals in the pipe, but nothing's been signed and inked. So if they all come to fruition, the gap will be filled, but that's a big if. So, but that can go to that mitigating, that slide that talked about risks versus mitigating factors. It's good news. You might at least have the leads to backfill a loss like that with a pipeline of others, but it's still a risk until those get signed up. Chris, you have a question?
Yeah, you mentioned jurisdiction for a lot of these home service companies like plumbers, electricians. How would we find out preemptively in our search if we are required to have that license?
Google and AI are wonderful sources for that, for a starting place.
Okay.
Good old-fashioned Google search can tell you, and the search would be nothing more than what are the licensing requirements to operate an electrical contractor in X, wherever your location is.
Perfect. Thanks for that.
You'll get a lot of input, often going straight to state statutes, state law, or like I said, what I will tell you, and I'm not going to make a political statement here, just so please bear with me when I say this. The further we move east, the more prohibitive some of these rules seem to be jurisdictionally. And it in the east is the only place I've seen townships have standards for licensing. And I'll pick on our good friends in Worcester, Massachusetts. They have a city code about electrical operators and plumbers. So something to be dealt with. And again, not saying you can't do it. It's just you need to understand the statute based on the jurisdictional specificity. A mouthful there. Putting my lawyer hat on for a minute. But yeah. But yeah, the quick answer is good old fashioned Google searches, or even now some of the AI engines are doing a real good job of articulating what some of those statutes look like. And at a minimum, they give you the agency to talk to go ask specifically. So, okay. Any others? Ben?
Hey, Doug, I've got a quick question on pricing. You kind of mentioned earlier that prior to an LOI being issued, sometimes there's wiggle room of up to 0.5 of an EBITDA multiple in price. I'm curious to get a general sense of how much that price might change throughout due diligence between LOI and final investment decision.
Again, I guess my true answer is it depends. There are a lot of variables. On multiple occasions, we've talked about this at our workshops. So here's the thing I want to encourage everybody to get in your mind. When you see an opportunity pop up, especially in the on-market deals, those are deals that are being promoted everywhere. So if it's a good deal, it is going to move fast. So if you want a shot, you need to move fast to try to rationalize whatever they may be asking with your own sensibility about what you're willing to do. And you can use the intrinsic value calculator initially. And sometimes all you can do is speak to what has been shared in the SIM on the listing. And that's where you'll make some of your margin adjustments to try to determine if you can justify the multiple they may be asking. If you're really close, what we typically recommend, and the intrinsic value calculator will tell you this, we typically will tell you whether we still think it's a really good deal or one you ought to be wary of. And if it's a really good deal, you ought to go ahead and jump on it, fire off your LOI, try to get in the game. All of the LOIs should be written with that contingency caveat of subject to your outcome of due diligence. So when due diligence happens, you might uncover some other factors that are going to impact the intrinsic value calculation, and that's where the multiple starts to slide. Now, it could go up. You could, in fact, uncover more gold nuggets than you even thought there were going to be. And we have seen it work both ways. But nonetheless, there are discoveries to be made during due diligence. And that's why we have the second pass of the intrinsic value calculator as a step in the process. But again, I'll stress, if the deals are hot and they look pretty darn good, you need to go ahead and be willing to move as quickly as you're comfortable to get your LOI in the game. In other words, you don't want to lose the deal over analysis paralysis. We want you to get comfortable in knowing that you can put out a reasonable LOI, reasonable meaning what you feel comfortable doing compared to what they're asking, and then get in the game, be there. It's kind of you have to be present to win sort of thing. And if you spend too much time agonizing or even truthfully working all this deck up to come to an IC that may take several days to get scheduled, you might have missed the window on getting an LOI on a deal. So we don't ever want you to hear us saying, you know, slow play everything, get the perfect number before you ever do an LOI, because you probably never get a deal, to be honest. So we want you to be competitive. We want you to be comfortable with it, but we also recognize you're going to have to learn how to be quick with it in order to compete in this on-market listing game that's out there right now. Good deals simply don't last that long on market. Nick, you had your hand up.
Hello, yes. I just had a question about whether or not, when it comes to like the length of the time that the business has been in operation, I'm talking to an owner right now where the business has been in operation since 2021. Do you have a firm like deadline, or like, I guess, cutoff on how long you want a business to be in operation for?
The typical look back period, the SBA banks that we all know about are looking at a 3-year history. Anything shorter than that, they're probably going to be not interested in getting into. But 21 is fine. If you've got solid track record since 21, that should work fine.
Okay, thank you.
Okay, anyone else? Going one last time. I know we're about up on our hour here. I want to respect everybody's time, but happy to entertain one more question if anybody's got one. Okay. Well, hearing none, I want to thank everybody for your time. I hope this was helpful. As always, we will have the recording posted in our archive over on ClickUp. So look forward to seeing you next time. Everybody have a great week. Bye.
Thanks, Doug.